in some, there's a question that I gave you to try in our last class, which was yesterday, the one of May 2019. The one of May 2019. Of course, I know between yesterday and today, there have been quite a few hours in between there, given the fact that most of us are working during the day. We also have other engagements, families by the side, in this case here to look after. But is there somebody who was able to just attempt that question? May 2019, is there anybody who was just able to attempt? Is there anyone who was able to attempt? There's nothing wrong if you say no. I just want to know whether there is anybody who was able to attempt something, however small. You know, it could be, there could be a possibility that all of you were able to finish the question, and as such, Mwalimu may not even do it. Response? Not yet. So when they keep quiet like that, chances are they never did the question. So I think I'm better off doing the question. So it's May 2019, question number 5. It's May 2019, question number 5. JESA, tours and travel. So we have here Advanced Financial Management, CPA, May 2019, question number 5A. Question number 5A. JESA, Tours and Travel, is a private company in the tourism industry. We did up to cash flows. We did up to cash flows. So can I start from cash flows directly? Is that will that be good for everybody? Will that be good for everybody, or I do it from scratch? I'm waiting for your response, kindly. Do I just get the cash flows, I discount them, or we do it from scratch?
From scratch.
From scratch.
Then another says start from cash flow.
So third person.
From scratch.
So from scratch. So you're told here, JESA Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of what here? 100,000. 100,000. So the total purchase cost, of 8 machines, of 8 computers, each for 100,000. This gives us 800,000. That is the total purchase cost. Installation cost for all the computers will amount to 80,000. Installation cost for all the computers. Ladies and gentlemen, we have here installation cost. Installation cost is 80,000. So of course, installation cost must always be capitalized. Installation cost must always be put into the initial outlay. So we have here the total outlay. The total outlay is 880,000. The total initial outlay is 880,000. So you're told the installation cost for all the computers will amount to 80,000. It is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. Therefore, the benefit here, once we bring on board these computers, ladies and gentlemen, our profit here will increase from 12.5 million, or rather from 12 million to 12.5 million. So the benefit of bringing these machines on board will be the 0.5 million, 0.5 million. That is the benefit. This benefit, they've told us, will increase the company's earnings before depreciation and tax. So this is the increase before depreciation and what you have, increase in profit before depreciation and the tax. So you're told the computers are expected to last for 10 years, after which they'll be obsolete with no resale value, with zero resale value, with zero resale value, with zero resale value. We are told the operations manager proposes that the computers will be used for 15 years with no resale value. We have someone else in this case here who is saying no, 10 years are too few. According to the operations manager, ladies and gentlemen, the computers here will have a useful life of 15 years. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at shillings 50,000 each. So we have some marketing manager saying that no, we can only make use of these computers for 5 years. And still, because 5 years are too few, we shall be having some resale value of 50,000 each. The probability distribution of the useful life of the computers is given as follows. So you can see the probability, we have the useful life of computers in years. The company is in the 30% tax bracket. So we have been given tax. Whenever we are given tax, depreciation becomes relevant. Whenever we're given tax, we must compute depreciation. We are told the company's cost of capital is 24% and they uses straight line method depreciation. They want us to give them the expected net present value of the project. And then number 2, the standard deviation of the expected net present value. Number 3, if the net present value of the project is less than 200,000, the firm will be exposed to a financial distress. So they want us to determine the probability that the firm will avoid financial distress, and they're telling us to assume a normal distribution. Assume a normal distribution. Ladies and gentlemen, the biggest mistake that most of the students who did this particular sitting made was to give us expected useful life. So most of the students went ahead and told us that the expected useful life from the table given on this, before this paragraph, last paragraph, or before required, there's a table given there of useful life. So very many students went ahead and did 0.2 times 5, plus 0.5 times 10, plus 0.3 times 50, and then they gave us an expected useful life. That one automatically put them offside. Offside, why? Because they got some useful life, and the useful life that they got, for instance, ladies and gentlemen, does not, or rather will not, for example, lead us to, like the one that we have here for 5 years, which has got some scrap value. Remember, they have given us some scrap values for different what year periods. So the best students, what the best students here did was to come and evaluate all those events separately. They went ahead and evaluated the events separately. So they did actually 3 columns. So we have here 3 columns. 3 columns. So we have our 3 columns here. We have our 3 columns. So they had a column here for 15, or rather for 5 years, 10 years, 15 years, 15 years, 15 years, 15 years. So, ladies and gentlemen, because they have given us, tax rate, the very first thing that I will do is to compute depreciation. And for me to be able to compute depreciation, I need the purchase cost, including in this case here, this installation. Purchase cost including installation, regardless of the useful life, this will be 880, and I hope you guys are able to see where the 880 is coming from. 880. The purchase cost for all the computers we computed was 800,000, and then to install this, we needed 80,000. So from there, come and give me the scrap value. Scrap values, if we will sell these machines at the end of year 5, you can see, ladies and gentlemen, they've given us scrap value. There is this particular note talking about marketing manager, on the other hand, argues that the company needs computers for only 5 years, after which they can be disposed of at 50,000 each. At 50,000 each. Remember, the computers in total were 8. So then 8 times 50, this gives us 400. Remember, this table of mine is in shillings, thousands. How about if we were to sell these machines after 10 years? If we sell the machines after 10 years, we're told there won't be any scrap value. The same applies, ladies and gentlemen, to 15 years. Now, given this, I should be able, the 3 factors, I should be able to give you the depreciation per annum. They have told us that we are depreciating our assets on a straight line basis. We are depreciating our assets on a straight line basis, on a straight line basis, on a straight line basis. And if that is the case, ladies and gentlemen, then straight line basis, we normally take initial cost minus scrap value divided by number of years, which are 5 years. Here I will talk of 880 minus 0 divided by 10 years. Here we'll talk of 880 minus 0 divided by 15 years. So, ladies and gentlemen, kindly give me these figures of depreciation. And again, I'm repeating, why am I computing depreciation? I am computing depreciation, ladies and gentlemen, simply because we have been given the rate of tax. So we have here 880 minus 400 equals, divided by 5 years. The first one gives me a full 96. The second one will be 88. The third one will be 880 divided by 15, which gives me 58.67. Could you kindly confirm that all these figures are correct? Kindly confirm those figures are correct. If they are correct, ladies and gentlemen, please come and double underline them. Come and double underline them, because now what I need is a cash flow statement. Remember, a cash flow statement for us, how does it look like? We have sales, we have costs. However, in this question, this examiner gave us the benefit of these computers. He gave us the benefit of these computers. He told us that once we bring on board all these computers, we have in this case here the increase in profit before depreciation and what year? Tax, which was coming to 500,000. You remember this was 12.5 million minus 12 million, which gave us 0.5 million, which is the same as 500,000. So in this case here, we have 500. We have 500 here. We have 500 there. 500,000 every year. 500,000, 500,000, 500,000, 500,000. Now, ladies and gentlemen, having gotten that, what I will do straight away, I will come and less my depreciation. I know there is that shortcut there, but I don't like it. I don't like it. I'll be telling you later on why. Just come and do it the traditional way. So come and less here, depreciation. Depreciation, we have the figures. We have 96 here. We have 88 there. We have 58.67 there. So come and deduct these ones for you to be able to give us what we call profit before taxation. So profit before taxation, what do we have here? We have 500 minus 26, which gives us 404. 404. We have 500 minus 88, which gives us 412, which gives us 412. 500 minus 58.67, which gives us 441. 441.33. Once I get these profits before tax, what will we do? We'll come and share this with our taxman. So come and share this with our taxman. So let's start. The taxation figure given there is 30%. The taxation figure given, ladies and gentlemen, is 30%. the taxation given there is 30%. So 30%, 30%, 30% of this. So we have here 441.33 times 0.3 because I already have this figure. So this one will be 132.40. 0.40. So we have 404 times 0.3, which gives us 121.2. Then we have 412 times 0.3, which gives us 123.6. So it's a track like that. Ladies and gentlemen, the moment I do it that way, whatever I will get will be called profit after what here? Profit after taxation. So then profit after taxation, this will be 404 minus 121.2. which gives us 282.8. We have 412 minus 123.6, which gives us 288, which gives us 288.4. And then we have 441.33 minus 132.4, which gives us 308.93. Ladies and gentlemen, remember in that particular Zoom platform of yours, you have an emoji like this one. So if these figures are correct, you simply tell us, yes, they are correct. If they're not correct, there's another one which says like this. Yes. For us to continue, ladies and gentlemen, please give us a sign that things are okay. Otherwise, we proceed like that, and then at the end of the day, we get ourselves being wrong. Are we okay? Even type there yes or just okay. Today you guys are not like the way you were yesterday. Yesterday you are really making contributions. It's okay. Thank you very much. Now, ladies and gentlemen, if this is okay, having gotten profits after tax, ladies and gentlemen, straight away I would endeavor to change these to cash flows. How do I change these to cash flows? I'll come and add the non-monetary. Add the non-monetary parameter. The non-monetary parameter here is the depreciation. So come and add back depreciation. Add back depreciation, and our depreciations are here. We have 96, we have 88, we have 58.67. Kindly come and give us these figures, and whatever we shall get here will be called cash flow. Whatever we shall get here will be called operational cash flow. So we are adding back. So I'm armed here with my calculator. I will talk of 282.8 plus 96 equals. This gives me 378.8. And then we have 288.4 plus 88, which gives me 376.4. We have 308.93 plus 58.67 equals, which gives me 367.6. Having gotten these cash flows, the next thing I will do is to come and discount them. And if my administrator here is able to see my figures down here, I'll continue. I'll come and give you, for purpose of discounting, I'll give you the PVFA, present value interest factor of an annuity. So whatever we have is an annual figure. It's an annual figure because profits are annual parameters. Even the depreciation, you got depreciation per annum. So whatever you have here is an annuity figure. So like now this one, what I'll do, I'll come and read from my table the PVFA, how many years? 5 years. What cost of capital? The examiner must have given us the cost of capital directly. The cost of capital given years and enrollment, they gave us 24%. They gave us 24. So here I will be reading PVFA, 5 years, 24%. This will be PVFA, 10 years, 24%. This will be PVFA, 15 years, 24% like that. So could you kindly give us these figures? Do we have 24% on our annuity tables there? Do we have 24% on our annuity tables? Do we have 24% on our annuity tables? Do we have 24% on our annuity tables? Do we have it or we don't have it? 24%. 24%. Do we have it or we don't have it? We have it. So go to the table called the annuity table. Annuity table, you read 24% up there. Move like this, ladies and gentlemen, we'll be able to see where our N, for instance, where our N is 5. And then I will read for us the figure that is there. The first one, 24%, 5 years. What figure are we able to see here, ladies and gentlemen? What figure are we able to see here, ladies and gentlemen?
2.7454.
2.75.
7454.
7454. Thank you very much. How about PV FAR? Still 24% up there, but down now 10 years. 10 years, down there 10 years. What do we have somebody as PV FAR?
3.66.
3.6.
619.
9. Thank you very much. Lastly, we have 24%, 15 years. 24%, 15 years. 24%, 15 years. 24%, 15 years. What do we have there, somebody?
4.00.
4.0013. If you allow me, I'll have to transfer this figure somewhere. If you allow me, I will have to transfer this figure somewhere. I'll have to take them up here. I'll have to take them up here. So, ladies and gentlemen, what do we have here? We have our cash flows. We have our cash flows. We have our cash flows here. Our cash flows, ladies and gentlemen, our cash flows, we have here 378.8. Here 10, we have 376.4. 376.4, and then we have here 367.6. So you guys have been able to give me the PV first. You've been able to give me the PV first, present value, interest factor of an annuity. So the first one you've given me is 2.7454. So in this case here we have 3.6619, and then we have, ladies and gentlemen, 4.0013. 4.0013. So could you kindly give me the present value of operational cash flow, of operational cash flows? Remember, these are cash flows that are associated with what here? Our profits, they are operations. Operational cash flows. So present value of operational cash flows, what are we going to do? We shall come and take these multipliers. We multiply them. So we multiply them in terms of 2 decimal places. In terms of 2 decimal places, ladies and gentlemen, what do we have here? In terms of 2 decimal places, what do we have, somebody? This by this.
1039.
1039.96. Thank you, and thank you very much. How about this one here, somebody? This times this, give us a figure. So we have this times this, give us a figure we write. 2 decimal places, don't forget. 1378.34. How about 15 years? When you multiply the 2, 15 years, what are we going to get at the end of the day here, ladies and gentlemen? 1470.88. Ladies and gentlemen, I could see very many students getting these answers correct up to here. But always, over 50% of the students will forget discounting of the scrap value. Scrap value is a future income, is a future cash flow that has to be discounted. So in this case, here come and give us the present value of scrap value, scrap value, scrap value. Present value of scrap values and gentlemen. Remember, like year 10 and year 15, we don't have any scrap. Year 10 and year 15, we don't have any scrap. We only have a scrap at the end of year 5. At the end of year 5, the scrap, if I remember very well, the scrap was 400 at the end of year 5. At the end of year 5, there's a marketing manager. On the other hand, we are told, argues that the company needs the computers for only 5 years, after which they can be disposed at 50,000 each. And remember, how many were they? 8. 8. So 50 times 8 is 400. But now remember that this income will come to this organization at the end of the 5th year. End of 10th year and end of 15th year, regarding resale values, we were told, ladies and gentlemen, that there were no any scrap amounts expected. So come here, present value of scrap, present value of scrap, take the 400 here, you multiply these with the PV of 5, 24%, because you are getting this money at the end of the 5th year. So now this time around, if you're keen enough, I'm not adding A here. It's not a PV thing. It's a present value interest factor of a lump sum amount. Of a lump sum amount, yes.
We say on 38/7/10 year, the labor is 3.6819, and therefore present value is 1385.87.
For how many years? For 10 years.
Yeah, 10 years.
For 10 years, there is somebody who is saying that this figure is not correct. For 10 years, there is somebody saying that that figure is not correct. For 10 years, there is somebody saying, thank you very much for that. For 10 years, it's supposed to be 3.68. Thank you for that. 3.68. 19. Please confirm this. Confirm that. Kindly confirm that. I've been able to use my calculator. I don't know why your tables were giving you different figures. Please confirm that. Can I have like 3 or 4 students saying straight away that now we have done the correct thing here? Can we have other students supporting this?
So I'm saying correct.
Correct. Thank you very much. So now take this 376.4 times this 3.68. So we have here 376.4 times 3.6819, giving us 1385.87. Thank you, and thank you very much. How about the other figures? 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 Presumably they are correct.
Okay.
They are okay, thank you very much. Now come here, ladies and gentlemen. This scrap value arising from the 8 computers will be coming to us at the end of the 5th year. At the end of the 5th year. So please go to those tables of hours, 24%, 5 years. What are we able to get here? Somebody 400 times PV, 5, 24%. What do we have? Somebody there? Somebody 24%, 5 years. If I wish, I can also use my calculator. 1 plus R, raised to negative n. So I'll talk of 1.14, 1.24 actually, raised to negative 5, which at the end of the day will be 0.3411. So 400 times 0.3411. So could you kindly give me that figure? Kindly give me that figure. Kindly give me this figure. Kindly give me this figure. Kindly give me this figure. So we have 400.
36.4.
136.44. So this is 136.44. We have said here the others are what here? Zeros like that. And then of course, if I'm a good student, what I will come and do here is to add so that you can get the total present value. Total present